So 90% of the companies that we've invested in out of our fund one were pre-revenue when we invested. So I would say that, like many pre-seed investors, part of what pre-seed means to me is that you're pre-traction, right? So, pre-product, pre-revenue. I think right now there's a lot of scuttlebutt around how important revenue ramp is. One of our highest flying portfolio companies has no revenue and they won't have revenue for 5 to 7 years. Sometimes there's the discourse actually overweights revenue, especially when you're in more technically complex categories where we would be measuring things like design partners, usage data, retention with with partners who aren't necessarily scaling revenues. I would say that companies that have product market fit, business model proof, they're tending to want to raise more money than we're leading, right? So Pear can play there, but that's not our core business. And so I'm not saying it's bad, but it's probably not for us, which I think gets into really what this is all about, which is about fit, right? Is there a fit between what the fund is looking for and who you are? And can you determine that fit? Can you pre-qualify that fit quickly so you don't waste a lot of time with people who aren't a match in that regard?
Yeah, I think at pre-seed, revenue is very nuanced. I'd hate to say like it's a negative to have revenue, but like for us, the most important thing at the early stage is like the team. But if a really good team is working on like what we deem as a bad idea and they've already got some revenue, we've learned that it's harder for them to actually like fully pivot. So like sometimes in that case, like if you have made a little bit of progress in like what we deem as a bad market, potentially that could hurt you a little bit. But I hate saying that revenue hurts because like everything as a former founder, it does not feel good to say that.
I think it's on a lot of founders' minds at the same time is like, do I wait or do I prove I can make 5K MRR? But there are also other
5K, 5K MRR doesn't mean shit.
Yeah.
Okay. So what matters is, can you prove that there's demand? And you can do that in a lot of ways. But tiny revenue that's not representative is not interesting. Like a great call with a referenceable customer that wants the thing as soon as you have it is a lot more powerful than 5K and MRR. So I think remember, we're trying to answer business de-risking questions. Like, is this truly needed? Can you build this in a differentiated way? 5K RMR doesn't tell us anything. Yeah, sure, someone will pay for it, but that's just not a material signal.
That's perfect because it leads me to my next question. There are other ways to prove market fit, right? There are other ways to prove traction. What are the elements that you guys value the most? Like kind of if you had a hierarchy of non-revenue traction, what do you guys value the most?
Yeah, for us, it's like a small number of customers that absolutely like love what it is that you're gonna build. Sometimes there's these massive wait lists of people, and like, look, that's not a bad signal. But what we care about, and it's business dependent, but the more people, or even just a couple people we can talk to that say like, this is solving a massive problem. We're willing to put money down now in advance because that's how bad we want someone to build this. I think those are ways to really prove that there's the demand. I mean, there's a bunch of other ways, but that's kind of one that comes to mind.
Right on.
Yeah, I think that's great. I think one that we're looking for is the founder's right to win. Like, what about this founder, their abilities or their background, gives this team credibility that in markets that will become competitive, and all these markets will become competitive, they have a right to win. So I think that's really about founder market. That's another way of talking about founder market fit, right? And it could be your professional background, your personal interest, your technical credibility, like all of those things can be meaningful in terms of ability to go after this opportunity. I think the other thing that is interesting on the consumer side would be distribution leverage. So I think you're seeing a lot of this like influencer founder crossover, and I think what investors are looking for there is distribution leverage. And so like on the enterprise side, you can get these kind of design partners to sign on and agree to be working with you. And that can be really materially demonstrable of an ability to win and customer demand. On the other side with consumer, if you don't have a mature product to sell, yeah, a big wait list isn't going to tell me that much. But if I see that somehow you've locked in distribution leverage, or like you're having those kind of same partnership distribution kind of conversations, that's going to be signal on the consumer side.
I mean, I love that you bring up signals, because that's the next question here. If you could only pick one that you value the most, strong team, early traction, market insight, fill in the blank, what do you guys leverage the most?
Team,
For
team,
us,
team, all day team, team. Yeah.
team. But it becomes really special, I think, when a good team like has a unique market insight for sure.
And I think that's actually a really important thing. So there are some pre-seed funds that are more like fellowships where they're backing people who don't know what they're doing yet. We won't do that, right? So we're looking to invest in a team that knows what they want to go do, and they're telling us why they uniquely can go do it, right? There are other funds that pre-seed who are just kind of picking out mid-career professionals who have distinguished themselves in some way, and they're going on like an expedition to figure out what they might want to build. And I think that's another aspect of the pre-seed market that we're not in. We don't invest in that. Other people do. So like South Park Commons is another pre-seed fund that's really known for doing that. So there are different things. So for me, it's team, but to Harris's point, it's not that just the person is good. It's like, why is this person the best person in the world or the top 10 people in the world to build this company?
I'd love to drill down on that a little bit. Uh, what do you guys use to assess team quality?
It's really hard. I think we talk about this at Pair almost every day, and like everyone has like their own, different tastes. And the hard thing about venture is like you don't know if anyone's taste is right for, a few years, maybe even longer. So for me, like I personally think of a couple things. I think can this person hire, can they sell, and can they fundraise? Because they're going to have to do all of those things. Would I go work for this person? Do I envision them closing deals? Would I put them in front of A16Z to raise their next round? Like those are all questions I think about. And then we look for someone, like we call it being spiky. So like you don't have to check every box, but you have to be like the best in the world at something, and really stand out at one thing. But it's really hard to quantify. Like I wish there was kind of a more objective way to do it. But once you talk to 100 or 1,000 or 10,000 founders, and like if you're a founder and you were in my shoes and you did that, you would start to see like some of the people that stood out. And I wish I could quantify it better, but it's kind of like it when you see it.
I love it. And I'm curious what Gull has to say here because, he's done a lot of fundraising. How did you prove, Gull, that you were a good team when you were raising your first rounds?
Yeah, absolutely. I mean, very complex question, a lot of nuance to it. But with my first company, we raised 120 million. We spoke with 400 unique investors over a period of like 3.5 years. With Metal, we're backed by Andreessen Horowitz and Y Combinator, and I think I've had investor calls over the past few years where I just like completely blew it, right? Like it was just a terrible, terrible call. And if I was on the other end of that call, I'd be like, this person's like, I don't know if they're in the top 50%, let alone top 10%. And then I've had calls that were, the opposite, right? And I think a lot of it has to do with just like the energy and sort of the conviction you have in what you're doing and specifically, conviction not coming out of a state of emotion, but out of, hard facts and objective realities of sort of the market you're building, right? And I think that's one, right? And when I speak with founders, like I can tell founders that have like a really deep sense of conviction in their product, and they sort of talk about different types of things and they focus on different types of things. In and then there's like so much more to it, but that's just like one thing, like just the depth of conviction they have. It just shows, and it leads to conversations in different directions sometimes. So
Mhm. That makes sense. And, I'm curious, Harris and Kate, we have a bunch of founders in here who are about to get in front of VCs just like you. Um, how much do you guys lean into pulling the founder into the conversation to get the most out of them? Like, what is your technique? Like, I guess, like, what should they expect from, you know, you guys when it comes to like the meeting itself? Like, are they going to have to push into this to prove that they're a great founder, or do you guys do some pulling as well? Like, what's your opinion on like how to get the most out of these meetings?
I'll let Kate take that one first, and I can go second. Yeah.
So, I mean, so I work in a partnership of 4 people. We're all different, right? So the first thing is like my style is not the same as like my partner Axel's style, and we're both GPs in the same fund. So it's not consistent, right? And part of what you have to figure out is like what is needed from this meeting today? What is needed from me today? And the other piece of it is where am I strongest? Right? Am I strongest living in the world of data? That might mean that you're going to be someone who's going to want to have supporting slides. Am I strongest conversationally? Then you might want to take it that way, right? So you both want to understand, and this is like an interpersonal like EQ test, is figuring out how do you manage the meeting. And honestly, it might be different if it's 9 a.m. on Tuesday morning or 4 p.m. on Friday afternoon. And that's the thing, is that I'm not a robot. Like, I'm a human. I'm a human who gets tired. I'm a human that wakes up excited. And so, you know, days are different. And I think when I was early in my career, I came up through venture. I was at a fund for 8 years. You know, when I was an associate, I was screening hundreds of decks a week and taking 30-minute calls back to back to back. And I actually found out that the best thing for me to do was to really sit back and listen. That the more I tried to insert myself, the more I ended up leading the witness, and I actually got less data. So, you know, the more mature I've gotten in my career, the more I'm trying to assess, like, what's the texture of this person? Who are they? How are they showing up? Not just what are they saying? And then are they able to like communicate in a crisp way the key things that I need to know without me pulling it out of them, right? So I think that not, you know, there are times when that colloquial conversation is good, and there are times when you really want to get into the slide and dig in. I would say you got to read the room, and it also depends on what you're building, right? So if you're building something that's deep tech, like you're going to need to have a different kind of pitch than if you're building something that's consumer. So it's pretty custom, to be honest. And I've also seen people raise successfully from me with completely different styles. So there's no one style that wins. Part of it that has to come through is who you are and why you're exceptional. And then if you're like a deep RTK GPS expert, you're going to communicate that to me differently than if you're like a consumer health person, right? So I think that it's really about your strength coming through and picking the format where you shine.
Yeah, I agree with basically all of that. I start every meeting with like a very quick intro on me and Pear, and then I immediately ask like, I'd love to learn more about you. Can you tell me about yourself? And I feel like, you know, in that introduction, more often than not, you get a pretty good sense of how the rest of the meeting's going to go.
Yeah, I want to like go kind of home in on that a little bit more. I'm trying not to say double click. Somehow it made its way into my lexicon, and I'm trying to banish it because we don't need to be saying that. First of all, no one double clicks anymore. Anyway, so the thing that I think Harris just said that's really important, the best founders spend most of the first meeting telling me who they are, right? And also listen to what we said earlier. The number one thing we're looking at is team quality. So you should spend most of the meeting telling me why your extraordinary story, what makes you extraordinary, and that should be told in such a way that it tees you up as the perfect person to start this business. I think one of the biggest mistakes I see founders make who are maybe outside of Silicon Valley or don't have access to those like insights is they spend a lot of time giving me like a detailed market analysis, and by the end of the meeting, they've told me nothing about who they are. And that's a huge mistake, right? The other big mistake I see is people who spend 20 minutes of a 30-minute call asking me questions about me, right? Yeah, I try to proactively give them the TLDR and Baukunst so that they've like, you know, got that. And if you want to ask one question, that's fine, but don't waste your 130-minute shot asking me a bunch of stuff about me, because I need to come away from the meeting knowing a lot about you to decide to give you more time. So there's a balance in that as well. And I thought Harris did a great job of, that's how I do it too. Little bit about me. Here's the TLDR. What do you need to know? And then, really jumping into them.
I love it. And you kind of danced around this concept here, but like I'm going to pivot hard to it. What are the pitfalls that founders need to avoid? Like, what is the number one way to get a no from you guys?
The truth is that 99% of people get no's from us. So one thing to say is that just because you get a no doesn't mean you made a mistake, right? Like you probably just weren't a fit, right? So like that's the hard truth about it. So I think I kind of want to start there. But Harris, do you want to go from pressing facts?
I agree 100%. Like, I think so many people ask this question, like, what did I do wrong? And it's less about what you do wrong and more about what you do right. Like, for every 100 meetings I take, maybe we invest in one founder. And, if you're founder 2 through 15, you're probably, even 2 through 30, you're probably a super impressive person. It just wasn't the right fit for us. So, even when I send pass emails now, it's like people, like founders, like really push back and is like, what could I have done better? What could I, have improved on? And, sometimes I don't have a great answer. But yeah, you just have to figure out like, how can you be the one person that stands out of everyone else that we're talking to at the same time?
Yeah, I love that you guys went super political on those answers. I'm not gonna let you off the hook though.
Okay.
Maybe I'll ask in a different way. What's the fastest way to a no from you?
Oh, like be a misogynist?
Ooh.
I will hang up on you. That's
Yeah.
pretty fast. And it happens. So that's pretty fast. Being rude. Like people are rude. People are rude to their co-founders. Like if there sometimes two co-founders are on the call and you see like some negative dynamic there, that's a real fast pass.
I would agree with that when the co-founders, like, cause that, like, the biggest reason startups die is co-founder breakups. And if you can tell on the call that there's not good chemistry between them, but I'll kind of go a little bit of a spicier take. Like when I first started venture, the rude founders used to like really bother me, and I think I would pass. But I do think there are examples, if you look at billion-dollar companies where like maybe the founders just aren't the nicest people. So like, do I want to spend the next 10 years working with folks like that? Maybe not, but I do think there are examples of some people that have a little bit more brash personalities that are effective. So just something to consider.
Do you guys think, thank you, by the way, that was great. Are there any like major misconceptions out there that you come across all the time that founders are leaning into?
I mean, I honestly think the yes. I mean, I make a lot of content, so I get a lot of questions from people all over the country, all over the world, and it's wild to me how many misconceptions there are. I've been in San Francisco since 2014, and I've been in startups since 2012, and so I think I sometimes forget that I'm like swimming in the world of like venture backed startups, and so everything about it has become very normal to me. But I think there are a ton of misconceptions. One recently that came up was people not understanding that like venture backed founders can pay themselves. And I think part of that is the early stage funding ecosystems outside of the Bay Area, particularly in, let's say, tier 2, tier 3 cities. There's a lot less early stage capital, and the expectations of those investors it seems very out of whack. Like they're, raising their eyebrows at, people paying themselves $30K a year, $40K a year, right? So it was wild to me when I put out the data of like what pre-seed and seed stage founders pay themselves. They're not making what they were making at Facebook, right? But yeah, they're like paying their rent, buying flowers for their spouse. Like they're paying themselves, 100, 150K, right? So I think that was one that was really sad to me, because I can imagine, like, if you think you have to have built the wealth to not make any money for any years, that would hold a lot of people back from trying. So that was one misconception that I really hope, people can disabuse themselves of.
Yeah. I don't know if this is a misconception or if this goes back to something, you know, founders get wrong when they pitch us. Is I meet a lot of founders, we're talking about their company. We get to the market size. One, too many founders do like we call it top down market sizing. So you're like, you know, the size of the total market is this and we're going to capture 10%. So therefore we're, you know, X billion. Like we really want to see bottoms up. Like there's this many potential customers. Here's their ACV on average. Like there's the total market size. But then aside from that, you know, you'd be amazed at how many companies pitch me and we do the math and like their market size is like 50 million or 100 million. Like our fund is 400, you know, million. We need like multi-billion dollar outcomes to return our fund. Like we're looking for markets that are 5+ billion. So, you know, when I meet a founder that, you know, sometimes is great and they're just going after a really small market, like my line is usually like, look, this business is great. Like you should start it. You should own 100% of it. And like when you sell it, like please invite me on your boat one day, but it's not a fit for Pear. So I see that a lot, like, you know, not understanding how VCs are thinking about, you know, market in terms of their business.
I think other things, I've seen a lot of founders who care more about IP than they should. Who like, you know, think that if they have good IP, then that means they have enterprise value, and that's just not true. And I think another piece is they think advisors matter more than they do. Like, you know, they're showing it's like a team of, you know, two co-founders and they've got like 7 advisors. And I think the right advisors can be really powerful, but like we don't look at advisors the same way that we look at full-time founders. I think advisors who are also investing, so like angels who are advising, that's like a much stronger signal because they're putting their own money in. The ones that'll take a call and we really understand how closely they're working, that can be very real. But the bar is extremely high, right? Like it better be like a former CEO of the incumbent or, you know, really exceptional advisors, because that's the level of advisor that we're looking for, not just like, I don't know, some mid-level manager.
I have a hot take that if you're going to put an advisor on your slide, they better be investors in your company. Even like if it's the former CEO, like if they're going to be an advisor to you, they probably have the money to angel invest. And like, that means they believe in you versus just kind of putting them on a slide. And then like, if you've given away like over 1% of your company to an advisor, like that is a hard no for me. Yeah.
And it's so interesting because that bar moved, right? Like in the 20 teens, it was very normal for a pre-seed advisor to get a point or two. And that's come down significantly, I think, because a lot of people didn't deliver on that value. I'll give an example. So we have a company that was pre-seed. They're actually based in Harris, you're in Boston, right?
Yep.
Yeah, they're based in Boston, and it's in the travel space, AI in the travel space. And the former CEO of Kayak, the former CEO of TripAdvisor, both of them, like one of them was already an advisor, was investing, was wanting to take a board seat. Another one was like a diligence call, and on the call he was like, I want to invest, right? So that's the kind of signal. And then he also wanted to take a board seat. That's the kind of signal we're talking about. It's like you get people who know the industry better than anyone else, and on their phone they're trying to see if they can get money in the round, right? That's the kind of like posture that we're talking about, not like, I met this guy at a party once, he agreed to be an advisor, I gave him half a point, and you know, I talk to him every once in a while. Like that, we're gonna get to that. Good investors are gonna peel back the onion and figure out what's really happening. It doesn't matter what the slide looks like, it matters what's really happening, and good investors are gonna figure that out.
I think we should probably have another webinar just to talk about advisors in this dynamic. It is insane. I've seen so many crazy things out there. But yeah, it's insane. Another thing, just a shout out from a few minutes ago. If you guys are wondering, a really good source to help you calculate your market size, Pear's website has an awesome methodology around like bottom up calculation. I think it's wonderful and it's definitely a great resource. Okay,
I agree, Harris. Like top down is a red flag for us. Like if someone shows a top down analysis, we're like red flag. So
yeah. So here we are, Pear shaping the market themselves. Okay.
I don't think Pear is unique in this. I think this is like been an axiom of like what strong founders do.
Also, wait, another thing, I'm actually curious to get your thoughts, just talking about market. Like this new thing of like Sam, Som, Tam has
I
popped up.
fucking hate that so
I don't,
much.
I just want like how many customers, how much are they going to pay?
Yes.
What's that number? Like, I
Yeah,
don't like,
someone's like, well, what's the Sam? And I'm like, what are you talking about? This is not how we
yeah,
think about
VCs
things.
don't do that. So like,
Well,
that's
and especially in pre-seed, right? Like we're investing where the puck is moving, so to speak, right? So like it's okay actually to me if your market's the bottoms up's a little bit small, but you can show me that that's going to transform over the next 10 years. And I can believe that market, you're going to pull spend from these other adjacent categories or whatever. And like that's also not going to come through in a top down either. So you're doing yourself a disservice, especially if you're, kind of expanding a market or like robbing market share from adjacencies if you do top down. So bottoms up is always the way to go.
Oh.
Yeah, I hate those bubbles.
Yeah.
I hit a nerve on that one. That was amazing. Okay, you guys ready for the lightning round? We've got a bunch of questions from the audience, and we can hammer through a few of them. Okay, what's the ramp, either revenues or some other metric that you're expecting post pre-seed? So they raise the round, like what is the like growth ramp that you're actually looking for? And do you have like a few examples, I guess?
I think it's so company dependent. I don't think there's like really any answers. Every company we sit down and talk to them after they raise a pre-seed of like, here's the metrics we think, you're going to need to hit to raise a seed, but it's like different in every instance. There are also plenty of companies that like, if their team is really, really good, you can still raise a seed round. Even without those metrics. I'd say the bar for Series A has gotten a lot harder. So like to raise a Series A, like there needs to be revenue and growth, and like there's some more standard metrics there. But for going from pre-seed to seed, it's very variable in my opinion.
Yeah, I totally agree. So we go through the same exercise. Like after we invest, we look at like what are the key things that we have to de-risk in this business in order to raise seed, and then what are the things that we have to prove are true. And so we like look at that framework. In an ideal world, like we're trying to figure out how do we show product market fit, and then can we also get business model proof? You typically can't get both before Series A. Sometimes you can, but those are the things we're trying to figure out if we can get to. But it's not really that quantitative for the most part, between pre-seed and seed. It's more about what are the key things we're going to show we can do risk in the business, or the things that we have to show we can do that others can't do. That makes this backable.
I love it. Okay. Just a reminder to the audience, 85 to 90% of these folks' investments are pre-revenue. So the question here is, what is the expected like valuation range you guys are seeing at this stage?
Yeah, go. You want to go first, Kate?
I think every pre-seed investor is like brains mush from valuations right now. It's like, or at least ours are. I think interestingly, in the last 6 weeks, we've done 2 pre-seed investments. One was at 7 post. One we're negotiating right now, and it's going to land around 15. So I think, like, I don't know if we're hopefully we win it, like knock on wood, everyone wish me luck. But that might end up at 14, 15, 16, 17. I don't know where we're going to land. And they're really different deals, really different team profiles, really different spaces. So I would say like the median right now for a $1 to $1.5 million round, according to Carta benchmarks, is 10 post, but that's 50%, 50th percentile, right? And interestingly, the bigger the round gets, the higher the price gets, and the companies aren't necessarily any different. So I think that like the total size of the round depends on where the median hits, and then the founder background, and then like how hot or not the space that you're in is. But pricing is basically based on perceived supply and demand. The more competitive it's perceived to be, the higher price you're going to get, the more pricing power you're going to have. The less competitive it's perceived to be, the less you're going to get. The 7 post, I will say, was a solo founder. Actually just posted a video about it today. So a solo founder, and they don't have their CTO yet. So you're going to get a valuation hit if you don't have your CTO yet. And it's a much smaller round. And there's some things that I think we can prove out really quickly. And we may then put in more money at a higher price. But I really wanted to get in with this founder, and was willing to kind of go earlier and go, with this solo founder, despite that risk. And so that informed the price there, just to give a sense of why on that lower price.
Yeah, it's consistent with what, we're seeing. So through PearX, like is our pre-seed kind of, traditional vehicle. We'll invest anywhere from 500K to 2 million, typically between 5 and 20 million valuation. So we try to own about 10%. Yeah, if we can get it under 10, we're happy. And then you're really, questioning, do you want to do the deal between 10 and 20? But nowadays, like we're seeing so many deals that are 20 plus, 50 plus, 100 plus with two founders and an idea. And we can't really play. And we're a big fund. Like we don't really even play in that world. Yeah.
And I do think like we're 2022, this fund is a 2022 vintage, like the pricing dynamics have shifted a lot in the last year. Like things have changed a lot. And I think everyone at Pre-Seed is like looking at their fund math right now and like how big is their fund, their ownership targets, like, and trying to figure out what, do we need to adjust? And a lot of people are, saying the BUBBLE word. I won't even say it out loud, and trying to think about like, you can't miss the great deals, but also the math has to make sense. And so those valuations, even though there's a supply and demand dynamic, as Harris mentions, they exist within a fund model where like the math has to math, right? And the way that we underwrite is any investment that we make has to be a shot on goal to return our fund. And so we look at like expected capital needed by that business, expected dilution for that capital, expected exit valuations for that business, and we have to be able to believe that we can get $100 million back from that. So there is underlying math that also creates the edges of where we're willing to invest, and there's also our ego. Where will our ego not allow us? Like what's the sound barrier of like what we're willing to do just based on ego alone?
Oh, that's like such a great answer. So everyone, valuation really matters. This is a really important aspect of it. One thing, here's a great question from the audience. What if one of three co-founders is still working their corporate job because they can't afford to give up a salary and health insurance immediately? Like they're pre-funded here. How do you guys work with that?
Yeah, I think there's nuances to everything. I think in an ideal world, like we love backing the teams where it's like we gave up our job, we quit, we moved to SF, we're all in, like we're living in a house eating ramen and we're just gonna figure it out. That's the easiest, to get conviction because those people have conviction themselves. But there are plenty of examples of us funding companies where, one of the co-founders is waiting till they raise some funding to go full time. Yeah, I think it depends on the situation.
Yeah, it's not great, right? and I think it also like if someone's mid-career has 2 kids in school, like lives in San Francisco, like I mean we'll also look at personal situation, right? So if they have like an implied high personal burn rate and it really feels like they're the breadwinner, it really feels like it makes sense that they couldn't quite leave. We'll look at that, but also if they've been at like Apple for 6 years, you're like, well, so we do look at how real does this feel, because co-founder breakups are one of the main reasons that early stage companies go under. And one of the things that we have to test is the conviction of the relationship, the conviction of the founders in the space, and yeah, that leap, so to speak, that leap without the net is like one of the first entrepreneurial tests. So we definitely have invested in teams where one person is still working full time. In that case, we'll also look at, well, how much are they producing, right? So if it's, let's say, the technical co-founder, like I would be a little bit more diligent on how much code have they been writing nights and weekends, how much blood, sweat, and tears are they putting into this? So yeah, we'll look at it situation to situation, but it's not ideal.
Right on. Well, we're definitely at time here. So if a founder in this audience thinks that they're a good fit for either of your funds, how should they get in front of you?
Yeah, right now we've got the PearX applications open. That's the best way to do it. It should take 10 minutes to fill it out, and like you're gonna get answers, quickly that way. Also, though, my job is to talk to founders, so I'm never gonna turn down an email. So it's Harris at Pear.vc, RIP to my inbox for just giving that out. But yeah, look, my job's to meet founders, and I love talking to founders. If you look at my schedule, it's back to back all day. So yeah, shoot me an email, and I'm happy to respond.
Yeah, same. I honestly think the hardest, and like, so I'm a GP, like I have to fundraise from LPs. And so like I have a lot of empathy for the fundraising journey. And I would say the number one enemy of successful fundraising is attention. Like it's really tough to get people's attention. And like people can email me, Kate@Baukunst.co. And you might not get time with me. So like just be prepared for that. I think that this is why, by the way, why the tyranny of the warm intro persists is because you get people in your network being like, you really need to pay attention to this person. This person's special. And I understand that that creates barriers to access, but it also is one of the things that converts attention, which is one of the hardest things to get. So you're welcome to email me. Also, we have a large portfolio, we have a large collective. If there's somebody who can vouch for you and be like, this person's really exceptional, that's a good thing, right? I have also invested off of DMs on TikTok. I've invested off of cold inbound through our inbox. So it's not the only way. But the more that you can find social proof to get me to pay attention, to get on the phone with you, the more you're going to get prioritized. So highly recommend figuring out how to like get social proof to help get attention. But yes, absolutely, you can also email me.
Strongly agree with Kate there. Like if you can go, even if you don't know one of our portfolio founders, if you can convince them to like talk to you and then vouch for you, like that makes me feel like now you can go cold outbound to a customer and figure out how to sell. So it's a skill in and of itself. So yeah, if you want to maximize your chances of getting time, like definitely go through a warm intro.
I love this. Because what I hear is, hey, it's our jobs to talk to founders. So yeah, you can get a meeting, but why give up the like leveled up social validation that you get through an introduction? Because the goal here is to get a check from these folks, not just get a meeting, right? And if you come in with that social validation, that can be really, really meaningful when it
Well,
comes to
even getting a meeting is hard. Like my
Getting a
calendar
meeting
is
is
back
hard.
to back. Like I have to tell founders no because I don't have enough spaces to take meetings. So like even to get a meeting, like you should come in warm. It's easier.
And I think that's the thing people don't understand is like our calendars are full of talking to founders who came through our networks, right? And so if you're not coming through our networks, you're kind of vying for one 30-minute slot a week that's not allocated, right? And so it really is attention, is figuring out how you can get signal to get attention. I think it's wonderful that Pear has this program. That means there's going to be a process to be in that funnel. But obviously, if you can get the warm intro to Harris, you're jumping to the top of the line, right? Same thing. You can go through our pitch inbox. We'll look at it, but you're going to have to find a way to like get to the top of the line. And that's social. So number one way is social proof.
Oh, that's so great, you guys. Again, thank you so much to our panelists for coming and just imparting all this amazing wisdom on everyone. Do you guys have any we just talked about so many things. Do you have any final remarks or anything? Or yeah.
Thanks for joining. Now you guys should go back to building your company. Yeah.
Yeah. Last thing I'll say is like it is really hard. And I do want to honor like every single person that's putting themselves out there and taking that risk. Like I have respect for you. Even if you don't get a meeting, like I respect the game. Like I respect that you've chosen to step on the field and like congratulations on making that, decision. So yeah, I just want to say that.
Oh, well, I think that's a great place to end it. Again, thank you so much to our panelists. Thank you so much to everybody who attended. We really appreciate you. Of course, we'll follow up with some other stuff from this webinar. But again, thanks, and everybody have a great rest of your Tuesday.
Thank you.
Guys.